Welcome to Stock Talk with Mike. I'm back with another video on Unity software, the real-time 3D engine for game developers and other AR and VR applications. I did a video that I put out pretty quickly on Friday after Unity reported earnings and had a subsequent sell-off. And I just wanted to follow up with some additional insights and data on Unity heading into the trading week. I'm going to talk about how Unity makes money, so their fee structure, and why they might have reported bit lower than expected guidance for 2021, and also talk about some of additional data that kind of adds to my conviction for Unity, including institutional buying and their customer base. And I'm also going to give a 5-year price target for Unity. So I didn't really get into it too deeply in my last video, but I wanted to talk about how Unity actually makes their money and their fee structure. So they basically make their money through two segments. They have what they call create solutions, and it's basically a subscription service that allows developers to create and develop 2D or 3D games and applications. And they can build those for both console, PC, or mobile, and can create virtual reality and augmented reality content as well. And basically the way the fee structure works is you can actually access the software for free, but it's based on how much revenue you make using the application that you make. So if your game or your application makes under $100,000 in revenue, there's actually no charge. But if it makes more than 100 but under 200, you actually have to pay $400 per year per seat. And then if it's over $200,000 a year, you have to upgrade to a pro or an enterprise solution, which ranges from $1,800 to $200 a month or $2,400 a year per seat. And for the enterprise, a minimum of 10 seats you're purchasing. They also have what they call operate solutions, which basically helps the creators monetize the content they create. So it's basically ads in games or within the software, and that might contribute to in-game purchases or acquiring new customers. So basically Unity would get paid a portion of revenue if someone clicks on a Unity built ad and they acquire that gamer, then they would get an acquisition fee on that transaction. So that's all pretty much for gaming. But they're also spending a lot in R&D right now, rolling out products for the other verticals they're pursuing. So just having to scroll through, you can get a sense of the number of products they have, both subscription-based and per-fee service. Industrial applications, there's a ton of them here. Creative workflow, and also things like education. I also can't help but provide a little more color on the guidance they gave, because I think this is ultimately what caused the sell-off. And I talked about it a fair amount in my last video, but they reported year-over-year revenue growth of over 40%. They beat analyst expectations. Losses were a much narrower margin than analysts had expected. So anyone that says that they reported worse earnings or earnings weren't as good or revenues weren't as good, that's not it. It really came down, in my opinion, to the perceived weakness in the guidance that they gave for the first quarter of 2021 of revenue of 26 to 32% range, and for the full year of 2021 of 23 to 28% range. That is a deceleration in revenue growth based on what they reported in 2020 slightly, and they have spoken about their goal of long-term sustainable growth of 30% year over year. So the fact that they're showing guidance for a range lower than that, I think raise a bit of red flags. Given that the stock had been on such a run, I think that was just a little worrisome to investors. And they gave a little bit of color as to the rationale for their guidance. They estimate that COVID-19 in 2020 boosted their revenue by approximately 25 million or 3%. And they speak to the fact that they took that out of their forecast for 2021. So they backed that out as if they didn't receive it in 2020 as far as calculating their growth. But honestly, with where we are currently, I expect there to be a very similar environment in 2021 as 2020 at this point. And another thing they speak to is some of the new privacy laws that are coming into effect on the Apple iOS system. the modifications on IDFA, and how it'll affect mobile game developers acquiring new customers. So basically what's going to happen is there's going to be a pushed update, and basically it's going to require that iPhone users have to accept for their personal data to be collected and shared by applications. And the assumption is a lot of people will not accept, and then it's going to make it more difficult to target ads and acquire customers. This could potentially impact the developers that use Unity's Operate solutions to try and acquire new customers, which ultimately could impact the acquisition fees that Unity receives through their Operate Solutions product. But if this 3% they're estimating, or $30 million in today's revenues, holds true, and it's not more than that, it's not a trivial amount, but I don't think it's going to largely impact the long-term prospects of Unity. But it's definitely something to keep an eye on and see if it has any kind of long-term impact on their Operate Solutions product. But their bread and butter really is their Create solutions. That's where the majority of their revenue comes from. Another thing to like about Unity, they have very low customer concentration risk. They have 793 customers that generate more than $100,000 in revenue or more. And that's a 32% increase from 2019. And they have 121 customers, or 15% of their customers, that generate more than 1 million in revenue for them last year. And that's an increase of 86% from 2019. So they have a large customer base that's generating a large amount of revenue for them. So that's really good. And I think one thing we really need to watch is this move into other verticals that I talked about in the other video. Because I mentioned that impressive stat that they have 71% of the top 1,000 mobile games are made using Unity. And that's impressive, but it also got me thinking that, and they've been stealing market share really quickly, but I also am thinking, well, there's only so much more market share they can take in the mobile game arena or gaming arena. But at the same time, I guess they're also going to benefit from the continued growth of the gaming industry. But it's these other verticals that they're aggressively pursuing that I think is going to see the next big leg in revenue growth for them. And right now, 105 of those 73 customers, or 13%, were industries beyond gaming. So it's still relatively low. And they speak to the fact that in their Q4, that these other verticals long-term, they see making up 60% of their market share in the future. So there's tremendous upside in these other verticals, whether it's education, engineering, and movie production, etc. So that'll be really interesting to watch, and I think there could be a lot of upside there. Also been hearing a lot of chatter about Unity's share lockup expiration. So typically with share lockups, I don't pay them a lot of attention. As a long-term investor, I don't think they're that important. And if there is a short-term sell-off, I just look at it as additional buying opportunity. But with Unity, they actually did things a little bit different. Employees were already allowed to sell up to 15% of their shares, look in the green here, right at IPO. So they've already had that access to sell some shares. So I think this could act as a bit of a pressure release valve and not cause that sell-off that you sometimes see when there's a flood of selling when that share expiration happens. But they have another 15% becoming available as well. So a second phase, 2 business days or 2 trading days after announcing full year 2020 results. And they just did that last Thursday, and I'm filming this on Sunday night. So on Monday, February 8th, when I release this, I believe is when the second 15% become available for employees to sell if they so choose. So something to keep in mind, that it could add some additional selling pressure if there is employees looking to sell. And the full lockup expiration will happen around February 24th, I believe. It's 180 days from when they IPO'd, which is August 24th. Just a couple data sets to help add to my conviction for Unity. Institutional ownership. So we don't have a lot of data history here, as Unity just became publicly traded back in August. And the most recent data we have is for Q3, but 142 funds that are managing over $100 million in assets actually picked up shares of Unity and make up 63% ownership. So that's pretty good, and it'll be interesting to see how that progresses next quarter and what kind of change in ownership we see. On Friday, we saw quite a significant sell-off in Unity after they reported earnings with some perceived weakness in their guidance they provided, I think. And interestingly, I was looking at Ark Invest, Kathy Wood's Ark Innovation Fund, the Ark K Fund. This was one of the highest performing actively managed ETFs last year, and highly respected group and fund, and manage a lot of dollars and assets. And what they did on Friday, they actually bought over $100 million in Unity, you can see here on the left, and actually increased their position weighting in their portfolio by 0.22%. When we saw, I think it was like a 13% sell-off in Unity. So they didn't just rebalance, but they actually increased their position when they saw that sell-off in Unity. Quick look at my 5-year price target for Unity. We just had full year 2020 numbers reported, so I was able to plug those into my analysis, and using their current share price of $128.64 per share, I've used a 35% compound growth rate over the next 5 years for this target. Last year in 2020, they saw 43% growth rate, and their long-term goal is revenues of 30% or more. So I think 35% is pretty reasonable. And if they accomplish 35%, they would grow revenues from 772 in 2020 up to $4,335 million by 2026. So that you can see how quickly that escalates when you have that kind of growth. And on the expense side of things, I think they'll continue to be able to improve their margins like they've been doing. Cost of sales, I've reduced from 22% to 20% of revenues, and advertising and marketing, as well as tech and development and admin, I've brought down to more industry standards as they increase their volume. I think these percent margins will continue to improve. So that puts them at I have them at a 60% expense margin, and I've used a 75 PE. Again, this isn't a forward PE, but I think 75 PE at a company that's growing at a clip of 35%, that is a software company, could be fairly reasonable. And that puts us at a share price of $480.30 a share in 2026, which is a 273% total return and just over a 30% annual return year over year. A lot can happen in 5 years, and who knows what market sentiment's going to look like, which can really wreak havoc on valuations as well. But I like to do this exercise to see where a company could be headed in the next 5 years, and I think it's very possible that Unity could be trading at $500 a share in 5 years. If you enjoyed this video and you haven't already, please consider subscribing to my channel, and it'd be great also if you could help me out by liking this video. That's about all I have for you today, so thanks for watching. Happy investing.